Welcome to our YouTube podcast, Top 10 Investing Hacks for Beginners 2025. If you're new to investing or want to refine your strategy for 2025, you're in the right place. Today, we're sharing 10 powerful investing hacks to help you start strong, avoid common mistakes, and grow your wealth confidently. These are actionable tips you can use whether you're just starting or looking to take your investing game to the next level. Don't forget to subscribe and hit the bell icon to get notified about our upcoming video, where we'll share a detailed guide on free learning resources for mastering investment strategies discussed in today's podcast. You don't want to miss it. And here's the best part. If you want access to links and files for free learning resources on investing, write SSTV in the comments and we'll make sure to hook you up. Let's dive in and unlock the secrets to smart investing for 2025.
Welcome back to the deep dive. Today we're diving deep into investing in 2025. You brought some really interesting articles about getting started and you know how to make smart long-term decisions.
Yeah.
But there's just so much information out there, it can be overwhelming.
It really can. I mean,
Right.
you see robo-advisors and micro-investing apps and all this new stuff. Where do you even begin?
Right. It's you need a finance degree to even get started.
Yeah.
Don't worry though, that's what we're here for today. We're going to highlight the key takeaways from these articles. So whether you're, brand new to investing or you're just looking for a refresher, we've got you covered.
Yeah, and one thing that all of these articles really emphasize is that you don't have to be a Wall Street whiz,
Right.
to start investing. The key is to, build that solid foundation and understand, the core principles.
Okay, so let's dive into that foundation. Setting goals before you even think about, specific investments. Why is that so crucial?
Well, think of it this way. If you're setting out on a journey, you need to know where you're going before you can map out your route.
Yeah.
Investing's the same way. You know your goals. They determine your strategy, your risk tolerance, and you know what kind of investments you're even going to make.
So if you're saving for a down payment on a house in a couple of years, that's a totally different strategy than someone who's, investing for retirement decades from now.
Exactly. So a shorter term goal like that down payment might call for lower risk investments like maybe bonds or a high yield savings account.
Mm-hmm.
But, if you're investing for retirement, you have more time to ride out those market, swings and things.
Mm-hmm.
So you might consider more growth-oriented portfolio with a larger percentage of stocks.
That makes sense. So step one is figuring out your financial goals first. And then you can tailor your investment strategy, to reach that goal.
Exactly. And speaking of, long-term goals and growth, let's talk about compounding. Something.
Okay. Compounding. It sounds a little technical. Why should our listeners care about this?
Well, think about it like a snowball rolling down a hill. It starts small, but, as it rolls, it gathers more and more snow and gets bigger and bigger.
Okay.
Compounding's kind of like that. Your earnings, they start generating their own earnings over time.
Mm-hmm.
And the earlier you start, even with small amounts, it gives that snowball more time to grow.
Okay. I think I see why they call it the magic of investing.
Yeah.
Do you have an example of how powerful this can be?
Yeah, for sure. One of your articles mentioned a study where someone invested $10,000 at age 25, earning an average return of 7% each year.
Mm-hmm.
By the time they hit 65, they'd have over $100,000.
Wow.
That's 10 times their initial investment. But if they waited until they were 35 to invest that same $10,000, they'd only have around $50,000 by 65.
That's a huge difference.
Yeah, it really shows how time is your greatest ally when it comes to compounding.
So starting early, even if it's a small amount, can really pay off big time in the long run.
Exactly.
Yeah.
And the other powerful thing about compounding is consistency.
Oh.
Now think about it. If you're adding to that snowball regularly, it's going to grow even faster.
Okay, so consistent contributions, even small ones, they can really add up over time, thanks to compounding. But what about risk? Both articles emphasize diversification. Can you explain what that means and why it matters?
And diversification is like that old saying, don't put all your eggs in one basket.
Right.
In investing, it means spreading your money across different types of assets, stocks, bonds, real estate, even different industries and countries. Helps reduce your risk.
So if one investment takes a hit, the others can help kind of cushion the blow. It's like having a safety net for your portfolio.
Exactly. Let's say you put all your money into, one single tech stock, and that company, they run into some hard times.
Mm-hmm.
Your whole investment would be at risk.
Yeah.
But if you had diversified across different industries, even if that tech stock, went down, the others might hold steady or even go up, and that would minimize your losses.
So diversification helps protect your investments from unexpected events. But with so many options out there, how do you actually diversify effectively?
That's where technology comes in. And luckily, one of the articles that you shared dives right into that. Tools like robo-advisors and exchange-traded funds or ETFs, they can make diversification a lot easier, even if you're a beginner.
Okay, let's break those down. What exactly are robo-advisors and ETFs, and how can they help with the diversification?
Okay, so a robo-advisor, it's basically a digital financial advisor. You answer some questions about your goals, how much risk you're comfortable with.
Yeah.
And then it uses algorithms to create and manage a diversified portfolio for you. It's like having a personal investment manager, but it's all automated and usually costs less.
That sounds pretty convenient, especially if you're new to investing and not sure where to start. And what about ETFs?
Okay, so ETFs, they're like baskets of stocks or bonds.
Okay.
And they track a specific market index, like the S&P 500. So by investing in an ETF, you're basically buying a small piece of all the companies in that index, which gives you instant diversification across a whole sector of the market.
So with ETFs, you don't have to research and pick individual stocks. You can invest in a whole sector with one purchase.
Exactly. And both robo-advisors and ETFs usually have lower fees than like traditional investment advisors or, actively managed mutual funds.
Okay.
That's really important because fees can eat into your returns over time.
Right. Every dollar you save on fees is a dollar that can potentially grow in your portfolio.
Exactly. So we've talked about setting goals, the power of compounding, and the importance of diversification. What else should our listeners keep in mind as they start building their investment strategy?
Yeah, what else?
Well, the importance of automation.
Automation. This is where technology really shines, right?
Absolutely. It's crucial for, staying consistent with your investments. Most investment platforms allow you to, set up automatic transfers from your checking account to your investment account.
Right.
This takes the emotion out of it. You're not constantly, checking the market and trying to time your investments.
So you're essentially putting your investing on autopilot. You decide how much you want to invest each month.
Yep.
Set it and forget it.
Exactly. And this leads into another important concept that was mentioned in the articles, dollar cost averaging.
Okay. Dollar cost averaging. What is that and how does it work?
So dollar cost averaging, it's a strategy where you invest like a fixed amount of money at regular intervals, no matter what the market is doing. So let's say you decide to invest $100 every 2 weeks.
Okay.
You just keep doing that, whether the market is up, down, or sideways.
So you're not trying to time the market or predict when to buy or sell. You're just consistently investing over time.
Exactly. And the beauty of dollar cost averaging is that, when the market is down, your $100 buys you more shares. When the market is up, you buy fewer shares. Over time, this can really help you average out your purchase price and potentially boost your returns.
It's kind of like, buying apples. When they're on sale, you get more for your money. When they're not, you buy less. But overall, you end up with like a good average price.
That's a great analogy.
Yeah.
And it really highlights why automation and dollar cost averaging work so well together. You're taking the emotion out of it and just letting the system work for you.
It's like having a disciplined investing robot working 24/7,
Exactly.
Yeah.
Now let's talk about another key concept that's like super important for investing success.
Okay.
Patience. Both these articles emphasize having a long-term vision and not getting caught up in, the short-term ups and downs.
Right. The stock market can feel like a roller coaster with all the, ups and downs. But one of the articles mentioned that historically the market has always trended upwards in the long term.
Yeah.
Why is that long-term perspective so crucial for success?
Well, if you're constantly reacting to like every dip or every jump, you're probably going to make emotional decisions. Buying high out of FOMO or selling low out of panic.
Right.
And those emotional decisions can really hurt your returns in the long run.
So it's about having the discipline to ride out those market fluctuations and trusting that, over time, the market will generally go up.
Think of it like planting a tree. You don't dig it up every day to see if it's growing.
Right.
You give it time, water, nourishment, and eventually it flourishes. Investing is kind of similar. You need to give your investments time to grow.
That's a great analogy. So we've covered some crucial things for investing: setting goals, compounding, diversification, automation, dollar cost averaging, and patience. What else should our listener keep in mind?
Let's talk about some specific investment strategies. One that both articles talked about is index fund investing. What exactly is an index fund?
Well, an index fund is a type of mutual fund or ETF that tracks a specific market index, like the S&P 500 or the NASDAQ 100. It basically tries to mirror the performance of that index by holding all or most of the stocks in that index.
So instead of trying to pick individual stocks, you're basically investing in a slice of the entire market. Yeah.
And why are index funds so popular, especially for beginners?
There are a few reasons. First, they offer instant diversification. Like, by investing in an S&P 500 index fund, you're immediately invested in 500 of the largest U.S. companies across a whole bunch of different industries.
Yeah, that sounds a lot easier than researching hundreds of individual stocks.
Exactly. Second, index funds are typically very low cost.
Yeah.
Since they passively track an index, there's no need for a team of expensive fund managers to actively pick stocks. This keeps fees low, which, as we talked about earlier, can make a big difference in your returns over time.
And lower fees mean more money stays in your pocket.
Exactly. And third, index funds have a proven track record. Studies have shown that over the long term, index funds often outperform actively managed funds.
So for someone who's just starting out, investing in a few broad market index funds can be a really solid, low-cost, and diversified foundation for their portfolio.
Exactly.
But what about someone who wants to be more hands-on and research individual stocks?
That's definitely an option too.
Yeah.
Key things to keep in mind when picking stocks.
Let's dive into that. What are some initial steps our listeners can take if they're interested in, researching companies and stocks? Where do they even begin?
Well, there's a ton of information available online. A great place to start is company websites. They often have investor relations sections that provide financial statements, annual and presentations to investors. These can give you a good overview of the company's business, financials, and future plans.
So getting familiar with the company's own materials is a great first step. What other resources are out there?
You've got financial news websites like Bloomberg, Reuters, the Wall Street Journal. They provide up-to-date news and analysis on companies and industries. You can also find analyst reports from investment banks and research firms. These reports can give you really in-depth analysis of the company's financials, industry, trends, growth prospects.
And then there are investment research platforms like Morningstar or Seeking Alpha that offer a wealth of data and analysis on individual stocks and ETFs.
Exactly. And don't underestimate the power of reading. Books by successful investors like Warren Buffett, Peter Lynch, Benjamin Graham, they can give you some really valuable insights into investing principles and strategies.
So there's a lot of resources out there to help you research and evaluate potential investments. But with so much information available, what are some key factors to consider when actually deciding whether to invest in a particular company?
The importance of looking beyond just the PE ratio.
Okay.
That price to earnings ratio that a lot of investors focus on. Well, it's a useful metric. It's just one piece of the puzzle.
Right. You can't rely on just one number to tell you the whole story.
Exactly.
What else should our listeners be looking at?
Well, consider the company's growth potential. Is it in a growing industry? Does it have innovative products or services? Is it expanding into new markets? These are all signs of a company with potential for future growth, which could lead to higher stock prices.
So you're looking for companies that are on an upward trajectory, not just companies that are currently profitable.
Exactly. Also look at the company's competitive position in the market. Does it have a sustainable competitive advantage? Something that sets it apart from its rivals and allows it to maintain profitability over the long term. This could be a strong brand, a unique technology, or a cost-efficient business model.
It's like finding companies that have a secret sauce or a moat around their business.
That's a great way to put it.
Yeah.
And don't overlook the quality of the management team. Are they experienced? Are they competent? Do they have a track record of making, smart decisions?
So you're not just investing in a company, you're investing in the people who are running it.
Exactly. And lastly, look at the company's overall financial health. Is it profitable? Does it have a strong balance sheet? Is it generating cash flow? These are all signs of a company that's, financially sound and can weather, tough economic times and keep growing.
So it's about finding companies with solid fundamentals, not just hype.
Exactly. Oh. Now, once you've done your research and you're ready to start buying stocks, there's a few additional things to keep in mind.
Okay, let's hear those. What advice did for once you've actually, decided to invest in a particular company?
One important principle to remember is let your winners run and cut your losers short.
Okay, what does that mean in practical terms?
So that means if you have a stock that's doing well and the company's fundamentals still look strong, There's no need to rush to sell just because the price has gone up.
So don't get spooked by a price jump and sell too early. Just, let those winning investments keep growing. Yeah.
Exactly. On the other hand, if you have a stock that's consistently underperforming and you've kind of lost faith in it, don't be afraid to cut your losses and move on.
Yeah.
It's better to sell and reinvest that money in something with, more potential.
It can be hard to admit when an investment isn't working out, but it's important to be realistic,
Yeah.
and protect your portfolio.
Now, while it's great to do your own research and pick stocks, there's also, other investment strategies that you can explore as you get more experience.
Yes. Let's expand our investing toolkit.
Yeah.
What are some other approaches that our listeners might consider?
One that's pretty popular is value investing.
Okay.
This involves searching for stocks that are undervalued by the market, companies that are trading for less than what they're actually worth.
It's kind of like bargain hunting in the stock market.
Exactly. Value investors believe that the market will eventually catch up and the stock price will go up to, reflect the company's true value.
That sounds intriguing, but it also sounds like it requires a lot of patience and like a contrarian mindset.
It does. You have to be willing to buy stocks that are out of favor with the market. But, that's often where you find the best opportunities.
Okay, so value investing is all about finding those, undervalued companies. What other approaches are out there?
Another one that's pretty popular is growth investing.
Okay.
Growth investors are focused on, companies that are expected to grow at an above average rate. They're looking for, companies that are disrupting industries, innovating, and expanding.
So growth investors are betting on the future, looking for companies that are, poised for big expansion.
Exactly. And they're willing to pay a premium for stocks that have, high growth potential, even if those stocks are currently expensive.
So it's higher risk, higher reward.
Yeah.
You're betting that those companies will live up to those growth expectations.
Right. Now, for those who are looking for like a steady stream of income from their investments, there's dividend investing.
Okay, dividends. What are those and why are they so attractive to some investors?
So dividends are payments that companies make to their shareholders, usually in cash.
Right.
It's basically a share of the company's profits that they're giving back to the investors.
So in addition to potential stock price, growth dividend stocks can actually give you a regular income stream.
Yeah. It's like getting a paycheck from your investments.
Okay.
And this can be really appealing to people who are nearing retirement or are already retired and looking for a source of passive income.
So dividend investing can be a good option for people who are looking for income and stability.
Exactly. Now, I know we've thrown a lot of strategies out there.
Yeah, we have.
So how does our listener know which one is right for them?
Right. That's the million-dollar question.
Yeah, and remember what we talked about earlier. Defining your goals.
Yeah.
The best investment strategy for you really depends on your goals, your risk tolerance, and your time horizon.
Right. If you're saving for a down payment in a couple years, you might need a more conservative approach than someone investing for retirement, 30 years from now.
Exactly. And your risk tolerance also plays a role. Some people are more comfortable with volatility and, the chance of higher returns, while others prefer a more stable, predictable approach.
It's about finding that right balance,
Yeah.
between risk and reward.
And remember, it's okay to combine different strategies. You could have like a core portfolio of index funds for broad market exposure.
Okay.
And then allocate a portion to individual stocks or specific sectors that you're bullish on.
So you can create a personalized investment strategy that reflects your, goals and preferences.
Exactly. Now, market cycles.
Right.
What are those and why is it important for our listener to understand them?
Yeah. What are market cycles?
Well, market cycles, they refer to the recurring periods of expansion and contraction that economies and stock markets go through. Think of it like a wave.
Okay.
It rises and falls, but over time, the general trend is upward.
So we should expect to see periods of growth followed by periods of decline. But in the long term, the market tends to, move in a positive direction.
Exactly. And it's important to understand this because market downturns are inevitable. They're not a reason to panic. They're an opportunity to buy stocks at a discount.
So when the market dips, it can actually be a good time to buy if you have a long-term perspective. It's like a sale on stocks.
Exactly. But it's also important to be prepared mentally and emotionally for those downturns. One of the articles you shared talked about the psychology of investing and how our emotions can sometimes lead us to make irrational decisions.
Yeah, investing isn't just about, numbers and spreadsheets, our emotions play a big role in how we react to, market fluctuations.
Oh, yeah, for sure.
What are some common psychological traps that investors fall into?
One common one is confirmation bias. Our tendency to seek out information that confirms our existing beliefs, even if that information is wrong or incomplete.
So we might be more likely to believe, positive news about a stock we own, even if there's negative news out there that we're ignoring.
Exactly. And this can lead us to hold on to, losing investments for too long.
Yeah.
Because we're just clinging to this belief that it's going to rebound.
Blinded by our own optimism.
Yeah. Another common one is loss aversion.
Okay.
Our tendency to feel the pain of a loss more intensely than the pleasure of a gain.
So we might be so afraid of losing money that we sell winning investments too early to, lock in a small profit. Or we avoid taking risks that could lead to bigger gains because we're so focused on not losing anything.
Exactly. Loss aversion can really hold us back.
And then there's herd mentality.
Oh, yeah.
The tendency to follow the crowd.
Yes. Often driven by fear or greed.
Yeah.
If everyone's buying a stock, we might feel like we need to buy it too, even if we don't really understand the company.
Right.
And the other way around. If everyone's selling, we might panic and sell, even if it's not the right move for us.
So how can we overcome these psychological biases and make more rational, investing decisions?
One of the best ways to fight emotional decision making is to have a well-defined investment plan.
Okay. Having a plan can help you stay focused on your long-term goals
Yeah.
and avoid those impulsive decisions based on short-term stuff and emotions.
Exactly. Your plan should outline your goals, your risk tolerance, how you're allocating your assets, and your strategies for rebalancing your portfolio.
It's like having a roadmap
Yeah.
to guide you through those, emotional ups and downs of the market.
Exactly. Another helpful tip is to, get some objective advice from a financial advisor or a trusted mentor,
Right.
someone who can give you a different perspective and help you stay grounded when the market gets crazy.
It's always good to have a sounding board, someone who can challenge your assumptions and help you make informed decisions. Now, I know we've covered a lot of ground in this deep dive, but there's one more important topic I want to touch on before we wrap up.
Sounds good. I think it's a fitting way to bring it all together. What is it?
It's the idea of finding joy in the investing process. I think it's a really important point, especially for beginners. Investing shouldn't feel like a chore or a burden. It should be something that you're excited about and engaged in.
Yeah, I totally agree with that. When you're genuinely interested in the companies and the industries you're investing in, it becomes a lot more enjoyable. It's like you're a part of something bigger,
Yeah.
Contributing to innovation and growth.
Exactly. And it's not just about picking stocks and watching numbers go up and down. It's about building a better future for yourself and your family. It's about, achieving your financial goals, creating a life of freedom and opportunity.
Absolutely. Investing can be a powerful tool for, reaching your dreams, whether it's buying a home, traveling the world, starting a business, or just, retiring comfortably. It gives you that freedom to pursue your passions and make a difference.
So let's bring it all together. We've covered a lot in this deep dive. What are some key takeaways our listeners should remember as they start their investing journey?
Well, first and foremost, remember that investing is personal. There's no one-size-fits-all approach. Your strategy should be tailored to your own goals, your risk tolerance, and your time horizon.
Right. What works for one person might not work for another. It's about finding what aligns with, your own circumstances and what you want to achieve.
Yeah, take the time to really think about, what are you hoping to achieve with your investments? Are you saving for a down payment, planning for retirement, or maybe aiming for financial independence? Once you have a clear picture of your goals, you can start developing a plan that makes sense for you.
And don't be afraid to start small. Even investing a little bit regularly can make a big difference over time, thanks to that compounding we talked about.
Yeah, consistency is key.
Yeah.
Make investing a habit, even if it's just a few dollars a week.
Yeah.
The most important thing is to just get started and let that compounding snowball start rolling.
And remember, diversification is your friend when it comes to managing risk.
Don't put all your eggs in one basket. Spread your investments across different types of assets, industries, and even different parts of the world.
And technology has made it so much easier to diversify. ETFs and mutual funds give you instant access to a bunch of different assets all at once.
And don't forget about automation. Setting up automatic transfers into your investment account can really help you stay on track and take the emotion out of it.
Speaking of emotions, we have to be aware of those psychological biases that can sneak in and, affect our choices.
Yeah, fear, greed, herd mentality, they can really trip us up.
For sure.
Having a plan and maybe even talking to a financial advisor or a mentor can help us stay grounded and make better decisions.
And remember, investing is a long game. Don't get caught up in the day-to-day noise of the market.
Stay focused on your goals. Ride out the dips, stick to your strategy. The market will always have its ups and downs.
Yeah.
But over time, it tends to reward those who are patient and disciplined.
And never stop learning. The world of investing is always changing.
There are so many resources out there today. Podcasts, books, articles, online courses, you name it.
Right.
Take advantage of them.
The more you learn, the more confident you'll become as an investor. And it's okay to make mistakes along the way.
Oh yeah, for sure. Investing is a journey of learning and growth.
Exactly.
The key is to learn from those mistakes and keep moving forward. Don't let fear or setbacks hold you back.
Investing can really be an empowering journey. It can change your life in so many positive ways. It's about taking control of your finances, building a brighter future, and pursuing your passions.
So embrace the journey, stay curious, and enjoy the ride. The world of investing is full of opportunity for those who are willing to learn, grow, and persevere.
Well said. That's a perfect note to end on. Thanks for joining us for this deep dive into investing for beginners in 2025.
It's been my pleasure. Until next time, keep diving deeper.